I'm Deborah Borchardt, and this is your midday market update. Well, it's Monday, and we are seeing the selling continuing as we begin the week. And joining me now is Mark Newton. He's the chief technician over at Greywolf. So, Mark, once again, we've got the Nasdaq really selling off. Not nearly as bad as what we saw towards the end of last week, but it still seems to be weighing on all the other indices as well.
I agree. This entire little correction, if you want to call it that, has certainly been led by not only some of the go-go momentum stocks, a lot of the biotech. The buying started to dry up as of early next week, and a lot of these started to turn down and make pretty bearish signs of breaking pretty good levels of support. And so I don't think that's happened yet with the S&P and the Dow. I'm not sure if that has to happen right away. I do think the deterioration in momentum is very serious. It's something that's been ongoing for really the last 8 to 10 months, and it's something that people need to pay attention to. Everybody's scratching their heads as to what the reason is behind the sell-off. People are saying, is it the Fed? Is it upcoming earnings? Is it macro? And it's really none of those things. The market has gone up for over 5 years, and you're starting to see the first sign of a gradual peaking out in stocks, I think. And that doesn't mean the market goes from highs to lows right away. I think it happens gradually where different things peak out at different times. Potentially you can make the case that happened to the Nasdaq. S&P and the Dow, I would argue, although near term they're still weak, we probably have a shot of rallying back to highs by the next few months, and that's certainly a time to consider getting out of stocks with regards to those indices, because I think we're certainly overdue for a bigger pullback, and I think we're slowly but surely starting to see at least real signs of technical deterioration that in my mind are a little bit of a concern.
Because I was going to say, some people are going to look at you or hear you and go, oh, but the Dow is still over 16,000. Right. What are you talking about? How do you answer that argument?
Well, you have to look at a few different things and not just the Dow. I mean, if you look at really relationships not only with our indices but around the world, you started to see signs of peaking out last fall with a lot of these indices, particularly with regards to the emerging markets, the Asian indices. Most of Europe peaked out in January, and we've not moved to new highs in things like the DAX and the Stocks Europe 600 index. And so the Dow has been fairly resilient, but it's important to keep your eye on the small caps. They always tend to lead. As of Friday, they broke down in relative terms to the S&P to new monthly lows. And so, from my opinion, if you look at all the U.S. indices, February lows are going to be very, very key to hold, and we're nowhere near that with regards to the S&P. 1750, is a long way away for the S&P. Near term, I think in the next few days, you try to find some support. I would look at the JPY and 10-year Treasury yields. U.S. equities have been following these things religiously since the beginning of the year. Those seem to have had a pretty good pullback. 260 is big on the 10-year. The JPY looks to be close to support. The Nasdaq has certainly been leading and should be something to continue to watch. If the S&P and the Dow were to get below March lows, that would make me a little more concerned. For right now, I think it's a short-term correction. You have to be a little more selective over the next few months.
All right, there you go. Some words of wisdom from Mark Newton, definitely seeing some yellow signs of caution. So some things to look out for here when you're trying to make your decisions in your investing. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with The Street.